Hey everyone, welcome back to your weekly market outlook. This is for the 19th to the 23rd of June 2023. So let's take a look at a pretty intense week last week. We'll start with the US CPI, obviously the inflation number from the US side of things. The headline inflation has gone down significantly. It was previously at 4.9%. Consensus was at 4.1%. We actually saw a drop all the way down to 4%. The core CPI remains stable at 0.4%. Now, we also get the PPI numbers. The PPI numbers was also a little bit lower, and that leads up to the FOMC decisions, right? With the decision, they decided to skip, and the key word is skip and not pause in terms of interest rate hike, indicating that they could potentially hike in July or the month after that, which is in August. With the new economic projections on the dot plan, it is as per consensus, or what we kind of expected what the FOMC would do, which is increase the interest rate target by another 50 basis points. And that's basically what we get. A few keynotes on in terms of what their interest rate target is for 2023. It could be at 5.6%. It could be at 5.75%. But that's basically the estimate in terms of how high the interest rate could go for 2023 in terms of the FOMC. With the FOMC, and then we are followed up by the ECB. The ECB also hiked interest rate this time around. Which is up 25 basis points across the board, and also very, very hawkish in terms of their press conference, really hawkish in terms of how they treat inflation. In fact, they actually made adjustments to the core CPI or the core inflation estimates for 2023 all the way up to 2025, and all of them is actually revised up. So it really goes to show how the ECB is taking a look at the inflation in terms of what they're anticipating. They're actually anticipating an increase in their core CPI projections for 2023 all the way up to 2025. So that's coming up from the ECB. Obviously, they're still going to not talk about their terminal rate. They don't have an interest rate target, and they're really persistent in terms of bringing the interest rate back down to 2%. In a timely manner, which is their wording of being as quickly as they can, right? And then we have the weekly unemployment claims in the US really showing up that the unemployment sector it's really shaking there. So in terms of the NFP numbers and the unemployment rate that we had, which is a little bit of a mixed bag this month, it kind of really points towards more on the unemployment rate being correct this time around. Okay, and then we have the Bank of Japan. Bank of Japan expected to, a lot of market participants are actually anticipating a tweak to the YCC or the yield control curve, giving the bond market a little bit of a breather, taking it up to 75 basis points, which is it's going to be a little bit more hawkish. We didn't have that. In fact, Bank of Japan remains dovish, no tweak to the YCC. So that really shift up the dynamics in the market there. So we've got FOMC slightly hawkish, right? We've got ECB very hawkish. We've got the Bank of Japan really, really dovish, and it really pressures the Japanese yen significantly. And that's just last week. Now for this week on Monday, we've got a US holiday, so just keep that in mind that the US is actually going to be closed Juneteenth for the holiday today, and then tomorrow we're going to have the RBA monetary policy meeting minutes coming out, which is going to explain why they actually did that surprise hike, which is not really that much of a surprise because the market was anticipating a little bit more of a hawkish RBA this time around. So we got that tomorrow on Tuesday, and then on Wednesday we've got the UK CPI numbers. Again, with the CPI numbers expected a drop from 8.7% to about 8.4 to 8.5%. Not really a significant estimate for that, but again, something we need to keep an eye out for, with the UK's inflation being kind of the highest amongst the major central banks. So that really puts a spotlight in terms of the Bank of England. They are likely going to be hiking interest rate by another 25 basis points. That's going to come out on Thursday. And also on Thursday, we've got the testimony Wednesday and Thursday, we've got the testimony from Powell to the Senate, right? And in terms of the testimony itself, what the market is going to be looking for is actually any hints to whether it's going to be live in July, live as in the FOMC is going to be hiking interest rate again in July. So any indications, we are going to be looking for hints throughout the hearings to see if there's actually going to be any signs that yes, the FOMC is going to be a little bit more hawkish. They're going to continue the interest rate hike in July. So any pointers to that, the market's going to be waiting for the testimony, which is going to be on Wednesday and on Thursday. And apart from that, we basically have the flash manufacturing and services PMI coming up from the Eurozone, the UK, and the US just to wrap up for the week. But yeah, it is going to be a pretty quiet week, but it is going to be a week where I think the market's going to be looking for key directions in the market. Okay, so let's take a look at the dollar index here. With the dollar index, we saw that significantly lower CPI numbers really dropping on the US side of things. We've got a really hawkish ECB commenting on being very aggressive in terms of their fight against inflation. So it kind of really pressures the dollar itself. We were anticipating the dollar to kind of had its limit at about 103. I didn't see that. Last week, I think we mentioned about a potential bullish flag on the dollar index. We didn't see that, so I'm just leaving the channel there. But we can see from the channel that we don't have that confirmed. In fact, the dollar index slides down even further. Right now, it is very close. It actually reaches 102 last Friday. Right now, it's just hovering around 102.35 on the dollar index. So we've got support for the dollar index at 102. In terms of how far it can go, right now it is inside the Ichimoku cloud. So we're going to be looking at supports throughout this week for the dollar index. Obviously, we've broken 61.8%, so we still have about 78.6%, which is estimating about 102. So we're going to be looking at 102 as kind of the key levels for the dollar index. See if 102 is actually going to hold out this week. If it doesn't hold out, if the dollar index slides below 102, then yeah, we're looking for more of a continuation for a weaker dollar. But that's where it becomes really uncomfortable if we take a look at all the other currency pairs. Now, for example, the Aussie USD here, this one has broken through 68 cents. If we take a look at the movement here, it kind of really grinds through towards 69 on Thursday and Friday. And if we take a look at where that 69 level is obviously at 200% extension. We're not really going to be focusing a lot more on the extension. What I'm really concerned about with the Aussie USD here right now is that this one here, we've seen the rally all the way up from basically throughout June, right? All the way up from 64.50 all the way up to 69 cents without taking a pause or a breather at all. Now, this is obviously reflected on all the other majors as well, but this is where it gets a little bit concerning because even though from a technical standpoint, we can't really call this an overbought condition, there's that constant nagging that the market has not corrected itself. It has moved significantly and hasn't seen any corrections at all. So if we take a look at the pivot levels, even the weekly pivot itself is at 68.30. This weekly pivot is above that key level at 68 cents. If we take a look at the support one, it is located at 67.70. It is where the Tenkan Sen is located. The support too, it's really far below 67 cents at 66.70. So basically just 1 cent away from the support one, and that's where the Kijun Sen is located. So if there's any correction, it could be a very deep, very quick correction, which is a really volatile in terms of range for the Aussie USD. In terms of resistances, we are kind of limited. We've got 69 cents, we've got 69.50, and then 70 cents, which is kind of the major psychological level for the Aussie USD. So you just keep an eye out on the Aussie USD here. This is really uncomfortable at this point in time, because if you're thinking of, it is a good run, and if you don't have a position and you want to jump in on the Aussie USD, in terms of stop loss placement, where is it going to be? Because we don't actually see any swings to kind of identify that as our potential stop loss. We're just not seeing that at this point in time. Now again, with the Euro USD, expected flag didn't happen. This is mimicking what the dollar index is, just in reverse. Also within the Ichimoku cloud, also extended beyond 61.6 61.8% retracement on the Fibonacci, daily Fibonacci. This one here still within the Ichimoku cloud, so we need this one to transition. In terms of whether or not can it spike towards 1.1, it could. We could see price move towards 1.1 and then find itself rejected at 78.6%. Now again, very similar situation with the Aussie USD. If you're thinking of, all right, very hawkish ECB, I think we should go long on the euro for a swing position. In terms of stop loss placement, where is that going to be? Because if you jump in right now, it is going to be at about 1.0950, and the closest or the nearest stop loss that you could have would be at about 1.07. So it is a significant thing to think about in terms of where the stop loss placement is going to be. And if you're thinking, all right, it might be a little bit overbought at this point in time, we're not seeing indication of this being overbought as of yet. And also, it's going to be a little bit early to just jump in on a sell. We don't have any significant technical patterns to look at in terms of, I think we can go short on the Euro USD. So this one here, again, it's going to be really, really tough. Even for intraday traders, if we take a look at the range on the weekly pivot itself, the pivot is at 1.0880. We got resistance one at 1.103, which is very significant. We're looking at a number that's higher than 100 pips. It's higher than a cent. If we take a look at the support one, it is located at about 1.079 or 1.08, and the difference between support 1 and support 2, if you take a look at it, it is significant. We're looking at about 160 pips away, which is at support 2, which is going to be at 1.0640, right? So it is going to be either a quiet market or an extremely volatile market this week, especially if we don't have any pointers. The only thing that the market is relying on right now this week is going to be that J. Powell testimony. All right, so this one here is going to be a little bit tough. And for pound USD, I think this one here has a little bit more room to go. For the pound USD, we know, and we've been saying that there's going to be more of an uptrend continuation, and we actually saw that trend continuation. In terms of resistances, we still have 161.8%, which is at 1.29, very close to resistance 1 on the weekly pivot at 1.2950. But beyond that, is obviously we're going to be looking at 1.3, which is a significant psychological level as well. The pivot itself is at 1.2720, just slightly higher than that 1.27 1.2666 level, which is the May 2022 high that was capping the market. So we've broken through significant key levels. I'm not going to say it is uncharted territory because, obviously we still have, previous highs to look at. We've got estimated highs to look at for the pound USD. At least for the pound USD, we still have a projected move towards 1.29. But again, if you're thinking of just jumping into the pound USD, the nearest stop loss that you could have is actually below 1.26. So think about it. It is a very significant range to consider, right? And then we have the dollar Japanese yen. The dollar Japanese yen, again, this one moves on the back of that weaker dovish, more of a dovish Bank of Japan. Now this is where it gets a little bit weird in terms of market dynamics. Now if I were to take the euro yen and the sterling yen, for example, the euro yen has basically returned to 2008 levels, right? The sterling yen has surpassed that 2016 high. Okay, so we are looking at the euro yen and the sterling yen gaining momentum, gaining strength. This is on the back of that dovish Bank of Japan. So for the euro yen, it makes a little bit more sense because in terms of the ECB, they're hawkish, Bank of Japan is dovish. So we saw that run on the euro yen. That makes sense. In terms of if we take a look at it from the FOMC and the Bank of Japan, then it also makes sense that we see a stronger dollar yen. But what doesn't click here is that we're supposed to be looking at a weaker dollar against the USD, against the euro and the pound and the Aussie, but it's just not reflected on the yen crosses. So you need to be very careful when you trade the yen crosses in terms of the dynamics in yen crosses. It's much more relatable towards the central bank dynamics rather than whether or not the US dollar is actually stronger or is it going to be weaker, right? So we actually have the dollar Japanese yen breaking through beyond 141 at this point in time. It's still very limited, right? As we mentioned previously, if we broke beyond 141, then we could see this one grind towards 143 and potentially towards 145. 145 is a key level to watch out for. That's because that's going to be the key level where, you know, the Ministry of Finance in Japan and the Bank of Japan is probably going to start, you know, yapping about potential intervention. But yeah, it gives room for a potential push towards 143, 145 on the dollar Japanese yen. This one here makes a little bit more sense in terms of the comparison to the Euro USD or the Pound USD, because if we decided to go long on the dollar Japanese yen, you can still have your stop loss placement at about 139, 138. You know, kind of still makes sense in terms of risk reward ratio. The only concern is that as the yen gets weaker, the pressure right now, it's a little bit more on the euro yen and the sterling yen that's really pressuring the yen at this point in time. I'm not sure what the stance is from the Ministry of Finance or the Bank of Japan, if they're actually going to intervene basing it on the euro yen or the sterling yen strength. That hasn't been the case in the past, but we don't know what they're going to be doing. I think the main focus for them would still be looking at the dollar yen kind of as the pivot points on whether or not they're actually going to intervene in the market. So I think attention is still going to be on the dollar Japanese yen, but at this point in time, if we can see on the dollar Japanese yen a little bit more room to go, I think we might see 143 in the near future for the dollar Japanese yen before we see any significant shift from a technical perspective or from a fundamental perspective. In terms of momentum, we still got room left to go, not overbought as of yet at this point in time. It is really concerning though, because we actually haven't seen a much deeper correction on the dollar Japanese yen, but again, this is dollar Japanese yen we're talking about, so it's pretty normal. Okay, all right, so that's pretty much it for this week. It's going to be a volatile week, and I think the market is again going to be looking for directions, whether or not it's going to be a correction. At this point in time, we're just not looking at any potential for corrections. We're at the same time, we're also not looking, we're not seeing any strong signs of continuation at this point in time. So market could be really volatile this week, so just take care, just pay closer attention to any potential technical patterns that could develop this week, but if you're more of a swing traders, I think this is a period where we need to see a proper pullback, a proper correction, or a proper continuation pattern before we can actually jump in on a potential trade. We need the market to kind of just pause us a little bit, you know, just go range bound a little bit, just create a little bit of a range so that, you know, the market can stabilizes itself on its footing before we can see any further progress in terms of trend continuation. Intraday traders trade within the range, and the range is actually going to be pretty wide itself, so just good luck with your trades. Be very careful, be more vigilant, and I'll see you soon.